Hello and welcome to the Crypto Culture Crew. Today we're going to be talking about crypto terms. My name is Sam. I'll be helping you guys go over all these terms. If you like this type of content, please go ahead and hit the like button, subscribe, and I'll be sure to give you more content just like it. With that being said, let's get right into it. So in crypto, you're going to hear a lot of different terms. If you're new to the space, you may not understand a lot of it, but it is important that you do have a grasp of it. That way, when you hear something, you can take that information and use it to your advantage. So let's get right into it. The first word that I want to go over is cryptography. So cryptography is actually where they get the word cryptocurrency. So if we go to Google and we search cryptography, let's see what they have in there. All right. So the definition that they have is an art form of writing and solving codes. So cryptography and blockchain is specifically what we're talking about. Let's see if they have a better description. So it says blockchains make use of two types of cryptographic algorithms: asymmetric keys and algorithms and hash functions. Hash functions are used to provide the functionality of a single view of a blockchain to every participant. Blockchains generally use the SHA-256 hashing algorithm as their hash function. So that's super technical. The way I understand cryptography is basically a way to transfer information securely, usually a public key and a private key. You send the information. Now you're gonna have a public key that everyone has access to, and you also are gonna have a private key that you will choose who you give access to. So that way, when you're sending information, they have their public key, but then you're also going to give them the information for your private key, so that way they can actually unlock the information that you're sending. So that's how I understand it. So that's kind of some of the little bit of the details of cryptography and why it's called cryptocurrency, because it uses cryptography to actually send the information as well. So the next term that I want to get into is blockchain. So what is blockchain? Blockchain is actually the underlying technology for cryptocurrencies. Now, here it says blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. A blockchain is essentially a digital ledger of transactions that is duplicated and distributed across the entire network of computer systems on the blockchain. So this is the actual power of cryptocurrencies, because they're all based on blockchain technology. And why it's so valuable is what you see here. It's almost impossible to change, hack, or cheat the system. So that's how they can hold currencies and things like that, and then have it securely held. That's why Bitcoin was the first one to use blockchain technology, and that's why it's so valuable now. There's actually a really good video on YouTube that I will put the link in the description that does a really good job of explaining it. I watched this video a couple times. Once I watched this video and I understood what actually blockchain was and the underlying technology of cryptocurrencies, that's when I really was like, all right, this is technology. This is the actual value that cryptocurrencies actually have. So once I understood that, I was actually a lot more willing to invest in it, because I believe that you're going to be able to use this technology in so many different functions in the future. And that's why I say if you get in now, you're so early, because they're still trying to figure out ways to use this blockchain technology in the real world that's going to have real utility and value to people. I would play the video, but I don't think you're going to be able to hear it. But a quick sample.
Like the name indicates, a blockchain is a chain of blocks that contains information. This technique was originally described in 1991 by a group of researchers and was originally intended to timestamp digital documents so that it's not possible to backdate them or to tamper with them, almost like a notary. However, it went by mostly unused until it was adapted by Satoshi Nakamoto in 2009 to create the digital cryptocurrency Bitcoin.
Okay, so I'm gonna stop it right there. I will put the link in the description, but basically what he's saying is, blockchain, the technology was actually created in 1991, but no one really used it until 2009 when Satoshi Nakamoto, the creator of Bitcoin, used that technology to make Bitcoin, and now we are where we are today. Really good video. I will definitely highly recommend it. You may have to watch it a couple times to really understand the technicalities of it, but once you understand the blockchain and blockchain technology, then I think you'll really understand what cryptocurrency is really all about and how it can be used going forward. All right, so the next term we're going to get into is smart contracts. So also with smart contracts, there's another really good video by the same channel. I'll put the link in there as well. And basically, you'll be able to understand what smart contracts are. Now, if we go to Google and we search smart contracts, let's see what they say. So on Google, it says, what is smart contracts in a blockchain? A smart contract is a self-executing contract with the terms of agreement between buyer and seller being directly written into lines of code. The code and agreements contained therein exist across a distributed, decentralized blockchain network. So to me, this is the most powerful technology that cryptocurrency has to offer is the smart contracts. So for me, once I understood smart contracts, I realized that that's where I would be focusing my investments on in the cryptocurrency space. I believe that in the future, you're going to see smart contracts used for real estate contracts. You're going to see them used for insurance claims. You're going to see them used by municipalities to keep a record of taxes, who paid their taxes, who didn't pay their taxes, all kept on a public blockchain that everyone has access to. And again, the reason why it's so valuable is it cannot be altered, changed, and it has extreme value. So right now, the main smart contract platform that is being used is Ethereum, which is why you see so much money going into Ethereum, because other people are understanding that Ethereum has a real utility as far as real world usage and how it can be used. And there's going to be companies, governments, entities, all trying to use this technology to help simplify and streamline their processes. So I'm going to, again, put the link in there so you can really understand this video. Smart contracts, to me, are going to be the future. You're using smart contracts in NFTs. That's how you can make them these non-fungible tokens. We'll discuss that in a later video as well. But to me, smart contracts are by far the most utility that you are going to get from cryptocurrencies at this current time. All right. Next, FUD. My favorite definition. So what is FUD? FUD is an acronym for fear, uncertainty, and doubt. Now, you'll hear this a lot in the crypto world, and I'll give you an example of FUD right now. So a really good example of FUD right now is that Bitcoin is horrible for the environment. It's not energy efficient. That everyone's using coal to produce it and things like that. So that is FUD that is created by somebody who is trying to manipulate the market to do what they want it to do. Now you're going to hear this term a lot. There's different examples of FUD that you're going to hear, throughout the cryptocurrency space. But when you hear these things, some of it is true, some of it is not. Bitcoin, I think right now, 75% of Bitcoin mining is done with renewable energy sources. So when Tesla came out and said that they're going to stop taking payments in Bitcoin because of this, it seemed a little fishy to me, because they knew that the Bitcoin was being mined before this, but something must have changed that made them put this information out. And as you saw, it caused the market to, especially Bitcoin, to crash about 50 to 60%. So you definitely got to keep a lookout for the FUD, people trying to manipulate the market and things like that. The more educated you are, the better you will be able to handle these situations when they pop up. And then you can use that to your advantage as well, like buying the dip. We'll talk about that as well. Next, bull market. So bull market is a term that's used by investors when the market is going to be going up. Now, we are currently in a bull market cycle. Supposedly, some people think that it's over after the big drop. Currently in the crypto space, and the crypto space, what you guys need to also realize is it's been going on for a very long time. So there was a bull run back in 2013, and then cryptocurrencies has a cycle of 4 years where typically you have about 2.5 years of a bear market, and then 2.5 to 3 years of a bear market, and then about a year and a half of a bull market, which is where everything is going up, and you can make a lot of money. So we were currently in a bull market. Some people think we're in a bear market. Some people think we're still in a bull market, and they do expect the crypto space to keep on going up. So now with these crypto, it's a little bit different. These bull markets are determined by Bitcoin's halving. So in 2020, Bitcoin halved. So every time there's a halving of Bitcoin, which means that the amount of Bitcoin that is being produced gets cut in half. This happens every 4 years. You usually see an increase in the price of Bitcoin and all other cryptocurrencies as well. So that happened back in 2020, which is why now you're seeing a big run up in the crypto space because it's currently in the bull run. Now, no one's perfect, but people are estimating that it's going to end around September, October, or sometime the end of this year. Other people are saying that because of adoption and more people using cryptocurrencies, that it could actually be extended into next year as well. So this is where your research and your understanding of crypto is really important because you have to make those decisions as far as what you want to invest in. When are you going to try to get out? Are you going to get out, or are you just going to try to accumulate more? There's a lot of different strategies as far as investing. You have to decide which one is best for you. That's why I'm making these videos, so that way you can have as much information and education as possible. And then now with that education and information, you can do what you like with it. I'm never going to give you guys financial advice. I'm not a financial advisor. I'm just trying to educate you so that way you can, make your decisions. So next, besides the bull market, is the bear market. The bear market is just basically when crypto has had its peak and then now it's coming back down. Now, typically it says here a bear market is when a market experiences prolonged price declines. It typically describes a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism, negative investor sentiment. That's why some people think it's a bear market right now because we had a 50% decline. This example is showing 20%. Now, the also thing you need to realize with the crypto space is a 50% decline is a lot, especially if you're dealing with stocks. But if you look at the history of crypto, it's actually kind of the norm. Like 50% drops, 40% drops, 30% drops. Those are kind of normal in the crypto space. On the stock market, that would be like, one of the worst things that could happen. But in the crypto space, it's pretty normal. And when you're investing in crypto, you need to understand that as well. There are going to be these drops, these huge swings in the market. It's typically because if you're investing in crypto, you're investing in a very speculative market. So as sentiment changes, as people's thoughts and feelings change on it, you're going to see that reflected in the price. I think right now everyone's really trying to understand what is the real value of cryptocurrencies, which is why you see it going so high sometimes and so low. But with that being said, there's a lot of opportunity as far as being able to make the right investments to actually make a lot of money. But also, you can lose a lot of money because if you get in at the wrong time and you sell at the wrong time, you're at risk of losing, part of your investment as well. So that's a bear market. The next term we're going to get into is shilling. You're going to hear this a lot, especially if you go on YouTube. Shilling basically is YouTubers, whoever get paid sometimes to talk about certain cryptocurrencies and projects. So that is called shilling. They are literally just trying to sell you. I'm getting a beer here, but they're trying to sell you an asset and pump up the price just for their gain. Whether the project is good or not, They don't care. They're actually just selling you the product because they were paid to promote this project. So if you're going on YouTube to try to follow YouTubers to tell you what to invest in, you need to keep that in mind that a lot of these YouTubers, some of these YouTubers get paid to discuss certain projects. And when you're investing in these, you may you may think it's a good project because they think it's a good project, or they may be talking about the project because they got paid a lot of money to talk about it. And then if you don't do your own research, you might invest in something that may not be as profitable as they make it sound like it's going to be. Next, ape. So that's a term that people use when they're talking about aping into a certain cryptocurrency, like aping into Doge. That means that you're going all in. You're putting all your money into it. You're not doing any research. You're not thinking about anything. You're just like, this project is going to be the best, and you go all in. You don't do anything as far as research, and you believe it's going to go. You're going to make a bunch of money, 2, 3, 4, 500% returns, things like that, and you don't do any research. I do not recommend aping into anything. I recommend dollar cost averaging. I will actually get into that as well, because when you ape into things, you could become a victim of a pump and dump. Not and dump, but pump and dump. A pump and dump is when anybody is really promoting a certain type of cryptocurrency or asset, like Elon Musk actually pumps a Dogecoin. Now he doesn't dump it. I haven't seen him dump it yet, but he's pumping it. He's advertising it. He's saying that it's the best thing since sliced bread. And when you have these pumps, it makes the price go up really dramatically because people get, FOMO, which I should put on here, fear of missing out, and they really just want to try to capitalize on what everyone else is getting into. But when the things pump, what you need to realize, especially in the crypto space, there's investors who invested much, much earlier than you have. So when they see a pump and they see the price go up dramatically, they will actually dump on you, which means selling their shares. And if you have large shareholders, or not selling their shares, selling their crypto, if you have large holders of cryptocurrency who are selling, that is going to make the price go down dramatically. So if you aped into something and you see it pump up, let's say the cryptocurrency was at $1 and all of a sudden it's at like $3, and you're like, oh my goodness, I need to get at this cryptocurrency at $3, and it goes from $1 to $3. The people who bought it in at 50 cents, when it hits $3, they're probably going to sell it and they're going to dump it on you. So now you just bought this asset at $3, and since they're large holders, when they sell it, that price is going to drop just as dramatically as it went up. And now that's how you can lose money. That's what's called a pump and dump. You need to be very, very aware of those. Again, if you're on YouTube and you're following YouTubers, a lot of YouTubers who have a lot of following, they can cause the pumps themselves, not even if they're even trying to, just because their followers believe what they're saying so much that they're actually buying these cryptocurrencies, making the price go up. But then the long time investors are like, oh, great, this is great. I'm seeing a big increase in my price. And then they go ahead and sell. And then that's when you get the dump. So the next term is hodl. So, or hodl, however you want to pronounce it. HODL means that you are investing and you are going to buy an asset and you are going to hold it. You're not going to trade it. You're not trying to make a quick buck. You're buying it for the long term and you're trying to hold it and HODL. That is the type of investing that I would highly, highly, highly recommend. I believe that is the best way to create wealth in the cryptocurrency space. Me personally, I do not try to trade because I don't have the time. I'm not that smart. What I try to do is I try to look for investments that I believe in and I buy them for the long term. And I'm not talking, 3 months, 2 months. I'm talking years. There's certain cryptocurrencies in my portfolio that I plan on holding for 5 to 10 years. That's my HODL portfolio. Other ones I believe in, but as the prices may change, I may change my portfolio to reflect that as well. So HODL is definitely, and hodling is something I would definitely recommend if you're trying to get new to the crypto space. And with that being said, only put in money that you can afford to lose, not money that you need to pay your rent or your bills and things like that. That is the type of investing that I would recommend, not the trying to get in, get out, and trade. Because if you're trying to trade, only a small percentage of traders are actually doing it at a really high rate where they're making a lot of money. And if you are not skilled at it, you will lose money. Again, not financial advice, just my opinion. Next, diamond hands. Diamond hands is very similar to hodling. It just means that no matter what, you are going to hold your cryptocurrencies. You're not planning on selling it. You're just holding, and no matter what, you are holding on to those cryptocurrencies. Where the term diamond hands comes from, you'll see that a lot. Some investors have diamonds hands, and then to get into the next term, paper hands. Paper hands means that no, you're not planning on holding long term. You will sell at the drop of a dime, no matter what happens. The market goes down 5%. You're gonna sell. You're just gonna get rid of any cryptocurrencies extremely easily. You're not gonna hold through any dips or any things like that. So, and that's actually what we saw when you saw that 50%, 60% decline. Is you have a lot of paper hands, people who just recently entered the crypto space, thought they were going to make a bunch of money, and then depending on where they're entered, probably lost some money, and then now they're actually going to sell those cryptocurrencies to try to mitigate and lessen some of their losses. So that's another thing that people do as well. Again, if you're trying to hodl, then you're not going to be worried about those dips, and you're going to have diamonds hands, and you're going to hold it for the long term. And even people who bought in at 60,000 for Bitcoin, yeah, it's down to about 40,000 right now. But if you're doing long-term investments where you're going to be holding Bitcoin for 3, 4 years, you will more than likely make more money than trying to sell it and then buy it back and things like that. So that's why I do recommend dollar cost averaging, not buying all at one time, but we'll get into that as well, where you're going to buy throughout time and not just all at one time. Next, I'm sure you guys have heard this term, to the moon. So part of aping in is when somebody thinks they're going to take a cryptocurrency to the moon, like Dogecoin. So if you're a Dogecoin investor and you got in at 1 cent, yeah, you're going to make a lot of money. But you got in early. With any of these cryptocurrencies or any investment in general, the people who make the most money are the early investors, the people who got in at a half a cent, at a quarter of a cent, and they invested in Dogecoin, and then now it's at 30 cents, or before at one point it was even at 60 cents. That's a 60 times return. You're not ever going to see those returns in the stock market. It's just, you think about Amazon or even Google. If you invested in those, you probably got a 200, 300% return if you invested when they first came out. But that takes years. With cryptocurrency, it is so volatile because you have the opportunity to make huge gains in a shorter period amount of time. That's where you hear that term to the moon, because people think it's going to skyrocket so high. So that's where the term to the moon means. The next term that I put on here, this is my own term, DYR, do your research. Again, don't rely on anyone else to tell you how to invest and things like that. Take all the information, do your research, and then make your own decisions. Decide what you want to do with your money. Don't don't wait for a YouTuber to tell you to buy XYZ coin, and then now you bought XYZ coin, and then it's actually a pump and dump. It goes up, it drops down, and you lose a bunch of money because you didn't do the research that goes along with it to make sure that you're making a sound investment. All right, so the next term is rug pull. You're gonna hear this as well. So in the crypto space, there's so many different cryptocurrencies. I think there's over like 8,000 or 10,000 cryptocurrencies. Certain ones, there's scammers involved. They are trying to do rug pulls. A rug pull is when a project comes out and they're telling you that this cryptocurrency is the best cryptocurrency since sliced bread. People put a lot of money into it, and then once all that money is into it, the creators then do a rug pull where they will literally either drain all the funds out of the cryptocurrency, or if they, depending on how the cryptocurrency was created, they sell a lot of their cryptocurrency and make the price go to basically nothing. So you do need to be aware of that. That's why it's so important to do your own research and not just follow other people's trades. You want to try to make sure that you're investing in good projects, quality projects. That way you don't end up in rug pulls. A big red flag is if there's a project and it's anonymous. That means that they're not putting their name on it. If they're not willing to put their name on it, why would you be willing to put your money and investments into it? So for me, if a project is anonymous, I'm usually probably not going to invest just for that simple fact, because if they're not willing to put their name behind it, then I can't trust it myself as well. So with that being said, next we have white papers. A white paper, by the way, I was got into crypto about a year and a half. I didn't know what a white paper was till about 6 months ago. So white papers really explain what the project is trying to do. This is CoinMarketCap. This is where I use and get a lot of my information. I also use CoinGecko. Um, but let's say you click on any specific currency. Let's take Ethereum, for example. If you click on Ethereum and you come into CoinMarketCap, it tells you here what the white paper is or where the white paper is. And the white paper should then explain what the project is trying to do, what they're trying to solve, what is the utility of the project. And here's Ethereum's white paper. This is introductory paper, was originally published in 2013 by Vitalik Buterin, who's actually one of the founders of Ethereum, before the project was launched in 2015. It is worth noting that Ethereum, like many community-driven open source software projects, has evolved since its initial inception. So it tells you here exactly what the project is trying to do, gives you information, it gives you the tokenomics, it gives you the roadmap, what they're planning on putting out, when they're planning on putting out. And these are the things that you really want to look at and really dissect and try to really understand before you make any investment into any cryptocurrency. If the white paper doesn't make sense or you don't understand it, then you probably shouldn't invest in it. Or if you do read the white paper and you're like, oh, this is a really good project, now you may be able to find a hidden gem where you can actually find a project that no one's really talking about, but it has a real utility that will then be valuable later on down the road. So that's what a white paper is. Next, ICO, IDO. So when it comes to ICOs and IDOs, ICO is an initial coin offering or initial digital offering. So basically, with that, what they're doing is they are giving out or selling a certain amount of coins at a certain given time. So every project has a different method of as far as how they're going to release their coins or tokens to the public. If you look here, you see circulating supply, and this is telling you how many coins are actually out there. And what you got to be really mindful of is certain certain projects, they don't release all their coins at one time. So let's say there's 1 million coins that they're going to be able to create for the life of the project. If they're only releasing 100,000 coins to the public, that means that 90% of the coins are still being held by them. So you need to make sure that you understand that when you're doing your purchases, because yeah, you bought these coins, but they're still 90%. So when they release that 90% out, it's going to lower the value of the coin, especially depending on how and when they do it. If they release it all at once, or if they're doing it, spreading it out, maybe releasing 5% every year or every 10 years, whatever the tokenomics of that particular project says that they're going to do. Next is a wallet. So this is really important. Now, when you go onto Coinbase or certain centralized exchanges, they will actually hold your crypto for you. But there's a term in crypto where it says not your keys, not your crypto. What that means is the whole point of cryptocurrencies, it being decentralized, is you own and you hold your own assets in a digital wallet that only you have access to, and you can send that crypto to somebody or receive crypto to that wallet as well. So it's really important that as you get more and more into it, that you have a wallet that you're actually using to hold, and you don't want to keep all your money on these centralized exchanges, because if anything happens to that centralized exchange and you no longer can get access to it, then now you don't have access to your cryptocurrencies. So it is important that you do create wallets where you're going to keep your some of your cryptos, and you spread it out, maybe even between multiple wallets to help keep you protected. All right, so there are some more terms that I wanted to get into, but we did cover a lot today. If you have any questions, put them in the comments. Any suggestions? If you like this content, please also put that in the comments. Like, subscribe. I'll be sure to give you more content like this. Also in the description, look for the links to the 2 videos I was telling you about blockchain and smart contracts, so that way you can have a better understanding of those. But until next time, guys, thank you for watching. I'll see you later.